What if I told you the most powerful part of the global financial system isn't inside banks? What if the debts shaping your future, your country, and the world's markets aren't controlled by central banks, regulators, or elected governments, but by private institutions you've never heard of? Shadow banks, private credit funds, unregulated lenders are moving trillions in the dark. And what if this hidden system is quietly recreating the same conditions that caused the 2008 financial meltdown? Tonight, we peel back the curtain on a financial world more secretive, more influential, and more dangerous than the one that collapsed 16 years ago. Because if history really does repeat itself, we are walking straight into another storm. Setting the stage, the world thinks banks control lending. The world thinks governments control credit. The world thinks regulators make sure risk is contained. But more than half of global lending now happens outside traditional banks. This parallel universe, comprising hedge funds, private equity, money market funds, CLOs, pension pools, and direct lenders, holds over $70 trillion in assets. Wall Street calls it the non-bank financial sector. Everyone else calls it shadow banking. Here's the twist. Shadow banks don't take deposits, so they don't follow banking rules and capital requirements, stress tests, no public disclosures, yet they lend to corporations, real estate developers, startups, governments, consumers, even entire countries. They behave like banks without having to behave as banks. And this freedom is exactly how the 2008 crisis began. But this time, private credit has taken the wheel, and no one is ready for what happens next. Origins: how shadow banking was born. Shadow banking wasn't planned. It emerged quietly as a loophole. In the 1970s and 80s, corporations needed more capital than banks could legally lend. Regulations capped interest rates. Rules limited risk-taking, so new players stepped in. Money market funds offered high returns without bank rules. Then securitization arrived, bundling loans into tradable assets. It created a simple formula. Bank makes loan, gives sells, loan gives shadow, system buys, gives packages, it gives investors profit. Risk didn't disappear, it simply moved. Banks became factories producing debt for a shadow empire. Then the 1990s and early 2000s arrived. Low interest rates, high demand for yield, and a belief that financial innovation had tamed risk. We know how that story ends. Rise: how shadow banking fueled the 2008 crisis. By 2007, shadow banking had grown larger than the global banking system. It created subprime bonds, CDOs, synthetic CDOs, SIVs, repo chains, and leverage stacked on leverage. Traditional banks weren't the main risk anymore. The hidden system was. No one knew where the risk was, who held what, how deep the leverage went. Then it all broke. Bear Stearns collapsed, Lehman fell, money markets froze, credit evaporated, the shadow system seized. The global economy nearly died. Central banks bailed out banks, but they couldn't bail out the shadows because they weren't supposed to exist. Breaking point: the twist after 2008. Here's the twist. The 2008 crisis didn't shrink shadow banking, it made it bigger. Governments tightened regulations. Banks became safer but also less profitable. They backed away from risky lending. And into the gap stepped a new monster: private credit. Private equity firms, hedge funds, and giant asset managers became lenders of last resort. In 2000, private credit was $40 billion. Today it's over $1.7 trillion. Blackstone, Apollo, KKR, Ares, Oaktree. These are the new meta lenders. They provide loans in the shadows, high interest, lightly regulated, fast, and heavily leveraged. And with rising interest rates, desperate corporations are taking these loans simply to survive. Just like subprime borrowers before 2008. Fallout: the risks no trade one is talking about. Private credit looks innovative until you see the dangers. Danger 1. No transparency. Private lenders disclose nothing. We don't know who's underwater until they sink. Danger 2. Loan stacking. Companies secretly borrow from multiple shadow lenders. Nobody knows their true debt. Not investors, not regulators, not central banks. Danger 3. No deposit insurance. If private lenders freeze, there's no FDIC, no safety net, just collapse. Danger 4. Loan to own. Some funds want defaults, but they can seize real estate, businesses, IP, and infrastructure. It's an acquisition disguised as lending. Danger 5. Liquidity mirage. Shadow lenders depend on investor cash. If fear spreads, funding disappears overnight, just like 2008. And worst of all, this system is now bigger than it was before the last collapse. Failed fixes: why regulations can't stop this. Regulators see the danger. They warn about it constantly, but they can't stop it. Shadow lenders aren't banks. They fall outside banking law. Regulating them would require rewriting entire financial codes. Governments need them, corporations rely on them, central banks indirectly fuel them, and cracking down could trigger a recession. It's the same dilemma as 2008, too large to regulate, too dangerous to ignore, a perfect trap. Modern parallels, eerie echoes of 2008. Look closely. The patterns are nearly identical. Then, mortgage bonds gives now. CLOs and private loan bundles then. Subprime lenders gives. Now private credit funds then. Homeowners drowning gives now. Corporations drowning then. Housing never falls, gives now. Private credit is safe then. Governments had blind spots, gives now they still do. And the most chilling fact, shadow institutions today hold more credit than banks did before 2008, yet the public has no idea. 3 takeaways. 1. Risk never disappears, it only moves. From banks gives to shadow, banks gives to private credit. The next crisis may not start in banks, it may start in private credit, in leveraged loans, in hidden deals no one sees. 3. When credit dries up, everything collapses. Companies, jobs, real estate, governments, markets, everything. Final warning, we are living through a financial buildup filled with hidden leverage, blind optimism, and invisible dangers just like 2008, except this time, the shadow system is too big to bail out. The question isn't, will something break? The real question is, where will it break first? And who will pay the price? Call to action if this deep dive opened your eyes. Hit like, subscribe, and share. The financial system has layers, and we've only just begun peeling them back. Stay curious, stay alert, and remember, the shadows always tell the real story.